That's right, you're watching Traders Corner with me, Bronwyn Seaborn, and joining me at the desk for a look at what the charts are telling us is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks for joining us.
Hi Bronwyn, good to see you again.
Yes, nice to be back at the desk. So the S&P 500 is just a stone's throw away from that 3,000 mark. Do you see us going through that, or what is the chart telling you?
Well, yeah, it's very interesting. It's very, very close to that 3,000 level. If you have a look at the chart here now, what I've been going on about the last few weeks is the significance of this 2950 overhead resistance level. And you can see that last week the market did punch through that 2950 area. It got incredibly close to 3,000. The spot market itself actually hasn't touched 3,000 yet, but on the 4th of July, on the public holiday, there's an after-hours CFD market that does trade 24 hours a day. And on that day, actually, the after-hours CFDs did touch 3,000. So, I don't know whether that counts or not, but in any case, I saw it, I took a screenshot and I tweeted it out to anyone who's interested. So, you know what, while it's above 2950 for now, that still probably is, we've probably still got to give the benefit of the doubt to the upside. What's likely to be very important this week is when Jerome Powell testifies at Congress and whether he strikes a more dovish tone or not on US interest rates. If he does come across dovish, I think that might be the kicker that the market needs to ultimately take it through 3,000. It's so close to that big round figure now that I would be very surprised if it doesn't at least go and tag that number and possibly just try and flush through it a little bit. So I think for the time being, that chart's still bullish. And while above 2950, I think we've got to continue to give the bulls the benefit of the doubt. If you look at the weekly chart of the S&P 500 here, this now goes back about 3 years or so. And what we've got here is this very big broadening, or you can call that a megaphone type of structure. And you can see how the market is now edging up towards the top right of that chart and beginning to get ever closer to the top boundary of that broadening pattern. And it does come in at just above 3,000. So, I think we go there. I think we touch 3,000, but I suspect, there and thereabouts, it may get a little bit sticky at that round figure. And we need to see whether it has any further push beyond that level or whether it then starts to consolidate. Because in each of the last couple of occasions, if you look at that S&P 500, when it has gone on and made a new high, it's only just made a new high and hasn't followed on very much, and then it's pulled back again. So it won't surprise me again if we see that type of situation where it pushes a little bit higher, makes a new high, but then doesn't manage to hold on to that for too much longer.
So let's just go to the announcement that you highlighted there, that testimony from Fed Chair Jerome Powell. The market was quite, I guess, euphoric that it was going to be a definite cut coming up in July. Then we had those jobs numbers from last week, which has kind of tempered the quantum, perhaps, of that cut. What are you putting your bets on, so to speak? Well,
that's right. And I think what that illustrates is just how addicted this market is to easy monetary policy. Because you're right, when there's the talk of dovish talk and dovish expectations, by dovish we mean expecting a rate cut, the markets seem to like that. They seem to be pushing higher. And as soon as any data comes out, which maybe scuppers that idea, like you said, the good unemployment figures, which suggest that maybe there's not a need for a rate cut if the US economy is still relatively firm, then all of a sudden the markets get all jumpy because now there's a concern that maybe they won't cut rates in July, which is what's very much been priced in. I think it's difficult to make a call on it. I think we're going to need to see what Jerome Powell says this week when he speaks. He certainly has left the door open for a rate cut in July. And I think broadly speaking, the markets probably now are expecting a rate cut in July. So if they didn't get that cut, or if we start to see more hawkish talk, then you may find that the markets possibly come off a little bit if that is the case.
Coming back home, though, our own market quite disconnected from the US market, while that market quite positive, gaining ground, our own market falling back a little bit. If we take a look at the top 40 that you've got there for us, what's that telling you about where we're headed here at home?
Yeah, so here's the top 40 chart. Last week on the show, I pointed out the significance of the 52,000 level as a lateral support zone. Now you can see that has turned out to be the neckline of a head and shoulders pattern. You can see quite clearly there the head, shoulder, and the two shoulders on either side identified. The fact that this market is now broken below 52,000, below the neckline of that head and shoulders structure, from a technical measurement perspective, it points to a target of actually 50,800. I think there's a typo on that slide. 50,800, in other words, just below 51,000 and just below that 50-day moving average, which is the red line over there. That seems to be what it's pointing to for us now. So I suspect it maybe goes down there, and then we see at that point whether the buyers are able to step up to the plate or not. But it does look for now as if the market has rolled over a bit in the short term, and whilst it's below that 52,000 neckline of that head and shoulders pattern, the bias does favour the bearish outlook for the near term anyway.
I suppose it is hard for our market. I know when you and I were on this show, we were describing the market as boring. And I get that sense still that there's not much action happening. There's not much pointers for market participants to take direction from.
Yeah, that's correct. And what we've also seen on the JSE is that volumes are very, very low. I mean, you saw it in the JSE trading update about, 2 weeks ago, when they said that their earnings are going to be down between 25 and 35%. I mean, that is a direct result of very, very weak volumes going through the equity market. And it hasn't changed. In fact, if anything, the last 2 weeks have been even more dull with very low volumes going through the exchange. So it's not an easy environment to be navigating at the moment. You have to be very, very stock specific, looking for your opportunities. And it's a tricky environment to be navigating locally. I must say, I've found for my own personal trading, actually, the offshore markets have been presenting more opportunities and seem to be following the technicals a bit better than what our local market has been.
Well, off the back of that, let's take a look at one of those trades that you did execute in Amazon, that being an offshore play that you've got there. What are we looking at staying in that trade for longer? What are the charts telling us?
Yeah, it's interesting. It's working out quite nicely for us at the moment, this trade. So just to revise what we did, about 3 or 4 weeks ago, we identified a little triangle or like a small pennant pattern that formed on Amazon.com with the stock moving above the 50-day moving average there and looking to break out to the upper end of that pennant pattern. I used that as an opportunity to go long of 7 CFDs at $1,889, and we're using a stop loss below 1855, and we were looking for a target up to the prior high, basically from early May there, which was coming in at $1,960 per share. Now, as you can see, it's working out quite nicely for us, and it's edging ever closer to that target level. Now, the question I have for myself is, do we take the profit here and lock it in, or do we try and run the profit and see whether we can extract more out of the trade?
Yeah.
The challenge here is that I've tried on a number of occasions this year to run a profit where we've been looking good on trades, things have been working in our favor, and I've said, let's try and run it, because that's the rule of trading, or one of the rules. Cut your losses quickly and run your profits. And it's something I've tried to get better at this year. But it's also been something that has actually stung us a few times, where we've been trying to run profits, and then something nasty happens and you end up giving back a whole lot of your profits. So it's a tricky one to navigate. Now, I may look to exit half the trade here at this target level, or I may look to cut the whole thing. But I certainly would like to take at least some of the profits off the table, given that we now are approaching the target area.
Okay, so closer to that point, we'll see what you decide in terms of how you play that exit. But then let's take a look at this week's trade. You're going local with a short on Mr. Price. You've had your eye on the trade for a little while, though. So speak us through the chart and what you saw there in the lead up to then executing that trade.
Yes, that's it. So Mr. Price is generally quite a weak stock at the moment. You can see the successive lower highs that I'm identifying there. And this is only over the last 4 months or so. But if you go back further, you'll see that this stock has been in a declining trend for a number of months. And what got my interest about 2 weeks ago was the fact that the share price was beginning to break out the lower end of that triangle structure. And that is a bearish break, and it suggested to me that there was further weakness to come. And I flagged it for subscribers to traderscorner.co.za originally, looking for a short as the price went up, and tested the underside of that 50-day moving average again after having broken down below the bottom of the triangle. Now, if we fast forward just another week, that triangle now looks as if it's evolved further, and we've actually got a head and shoulders pattern over there now, with the neckline coming in at about 196 Rand per share. and the price is now broken below that neckline, which really suggests to me that it's probably going to go back to the prior lows at 180 and retest those prior lows. So what I've done over the past couple of days is I've actually gone short at 198 Rand and 30 cents. I'm using a stop loss above 205, so a reasonably loose stop loss, and I'm looking for a move back down to those prior lows that we saw in March and again in May, which come in at 180 Rand. And you can see the yellow and green, the red and green blocks here. The red represents the risk, and the green represents the potential reward that we have on this trade. And you can see the reward is nicely bigger than the risk is.
Okay, so then let's go through the mechanics of it all.
Right, so we are short from 198 Rand 30 with a stop loss at 205 Rand. The risk per share, therefore, is 6 Rand and 70 cents. I'm going to risk 1.5% of our South African portfolio here. So we've got 156,000 Rand in the portfolio right now. 1.5% of that amount is 2,340 Rand. That's what I'm willing to lose if I'm wrong on the trade. I take the 2,340 Rand and I divide it by 6 Rand 70, and that gives me the position size that we can trade here. So it rounds up to 350 CFDs. That's what I've gone short of for the portfolio this week. A target of 180 Rand, as mentioned, and that means that our risk to reward ratio on this trade is 1 to 2.7, which is pretty decent in my eyes.
Okay, so hopefully that trade pays off for us. Let's take a look at the portfolio, starting off with the local portfolio.
Yeah, so the local portfolio has picked up a little bit this week, thanks mainly to the mark-to-market profit that we've got going on that Mr. Price trade. So we're up 6.2% for the year to date there. And then on our offshore portfolio, things are also looking a little bit better thanks to the gains that we've seen in Amazon and that trade there. So we're actually now on the right side of the ledger with this offshore portfolio after a year of not doing too much on this part of the portfolio. I am at least pleased that we're on the right side of the ledger here now.
Long may it continue. Garth, you've also got a course coming up on the 3rd of August in Johannesburg. If you just want to attend the course or get some more information, how do they contact you?
Yeah, please email me, garth@traderscorner.co.za. It's a high probability trading course on the 3rd of August. It's a Saturday, all day. If you're interested, email me and I will send you all the details.
Great. And then also just a reminder to our viewers that they can also subscribe to the weekly newsletter as well.
Yeah, that's right. If you go to traderscorner.co.za and you go to the middle of the page, you'll see a link there for a free weekly email. Enter your details. It'll take 1 minute of your time, and then we'll send you an email every Tuesday detailing exactly what is coming up on this show for the week ahead.
Garth, thanks so much for your time today.
Thank you.
Garth McKenzie is editor and founder of Traders Corner.